Many people believe that starting a business is all about making sales, attracting customers, and increasing profit. While those goals are important, they do not guarantee that your business will survive. In this video, you will learn 7 cash flow mistakes to avoid when you start a business. Number 1. The cash reserve mistake. One of the biggest mistakes new business owners make is believing that every dollar sitting in the business bank account is available to spend. After receiving their first few customer payments, many entrepreneurs immediately invest in better equipment, office furniture, software, advertising, or additional inventory because they want the business to grow quickly. While growth is exciting, unexpected expenses are guaranteed to happen. A major customer may pay 30 days late, equipment may suddenly fail, sales may slow during certain months, or an emergency repair may appear without warning. Without a cash reserve, even a small surprise can create a financial crisis. Business owners often end up using expensive credit cards or loans simply because they have no emergency cash available. A healthy cash reserve acts like financial insurance. It gives the business time to solve problems without making desperate decisions. Successful companies understand that cash sitting in the bank is not wasted money. It represents stability, flexibility, and peace of mind. Before spending on growth, make sure your business has enough cash to survive unexpected challenges that every business eventually faces. Number 2. The fake profit illusion. Many first-time business owners confuse profit with available cash, and this misunderstanding creates serious financial problems. Imagine your business sells $50,000 worth of products this month. On paper, the income statement shows a healthy profit after expenses, so everything appears to be going well. However, what if most customers have not actually paid their invoices yet? The sales have been recorded, but the cash has not arrived. At the same time, suppliers, employees, rent, insurance, and utilities still need to be paid immediately. The business may look profitable while the bank account continues to shrink. This is the fake profit illusion. Financial reports can show success, while daily cash flow tells a completely different story. Smart business owners always review both their profit and their cash flow statement together because each report answers a different question. Profit measures long-term performance, while cash determines whether the business can continue operating today. Never assume a profitable business is automatically financially healthy. If cash is not coming in fast enough, profit alone cannot pay bills or keep the business running. Number 3. The busy but broke problem. Many business owners believe that being busy automatically means the business is succeeding. The phones keep ringing, new orders arrive every day, employees stay occupied, and customers continue walking through the door. From the outside, everything looks successful. Yet when it's time to pay payroll, suppliers, or monthly bills, there is very little cash available. This happens because activity does not always create positive cash flow. Some businesses accept jobs with very low profit margins simply to stay busy. Others allow customers long payment terms while paying suppliers immediately. Growing inventory, rising operating expenses, and slow collections quietly consume available cash even though sales continue increasing. Business owners become trapped in a cycle where they work harder every month without improving their financial position. The goal of a business is not simply to stay busy. The goal is to generate healthy, predictable cash flow that supports sustainable growth. Instead of measuring success by how full your schedule looks, measure it by how much cash your operations consistently produce after covering every business expense. Busy businesses fail every year, but businesses with strong cash flow continue growing even during difficult times. Number 4. The seasonal cash trap. Many new business owners assume that sales will remain steady throughout the year. They build budgets, hire employees, and commit to recurring expenses based on their busiest months without considering how customer demand changes over time. Almost every industry experiences some level of seasonality. A landscaping company may slow during winter, a retail business may depend heavily on holiday shopping, and a tourism business may earn most of its income during only a few months each year. The problem begins when owners spend money as if the busy season will never end. Then, when sales naturally decline, the same fixed expenses continue arriving every month. Rent, payroll, insurance, loan payments, and software subscriptions do not decrease simply because customers temporarily disappear. Without proper planning, a profitable business can suddenly face serious cash shortages. Successful business owners prepare for slow periods while business is still strong. They save part of the extra cash earned during peak months instead of spending it immediately. Seasonal businesses do not fail because demand changes. They fail because they spend today's strong cash flow without preparing for tomorrow's predictable slowdown. Number 5. Financing the wrong assets. Not every business purchase should be paid for the same way, yet many new entrepreneurs make this expensive mistake. They often use short-term cash to buy long-term assets such as machinery, delivery vehicles, expensive computers, office renovations, or production equipment. These assets may help the business for many years, but the cash leaves the bank account immediately. As a result, the business becomes cash poor even though it owns valuable equipment. The opposite mistake is just as dangerous. Some owners finance short-term operating expenses with long-term loans. They borrow money to cover payroll, advertising, or inventory that disappears within weeks, but continue making loan payments for several years. Both situations create unnecessary pressure on future cash flow. A smarter approach is to match the financing method with the useful life of the asset. Long-term assets are often better supported with long-term financing, while daily operating expenses should ideally be paid from operating cash flow. When financing decisions match the purpose of the purchase, the business maintains healthier cash flow and avoids creating financial problems that continue long after the original purchase has been forgotten. Number 6. The tax time shock. One of the most painful cash flow surprises for new business owners happens when tax season arrives. Throughout the year, the business generates sales, collects customer payments, and the bank account looks healthy. Confident that everything is going well, the owner reinvests most of the available cash into inventory, marketing, new equipment, or expansion. Then the tax bill arrives, and there is not enough money left to pay it. The business suddenly faces penalties, interest charges, or emergency borrowing simply because taxes were never treated as a future obligation. This mistake is common because tax payments are often delayed, making owners believe the cash belongs to the business. In reality, part of that money may already belong to the government. Successful business owners treat taxes as money that is temporarily being held, not money available for spending. They regularly estimate future tax obligations and move those funds into a separate account long before payment is due. By planning ahead, tax season becomes a routine business expense instead of a financial emergency that disrupts operations and drains valuable cash reserves. Number 7. The empty bank trap. Many business owners check only one financial number every morning: the balance in their bank account. If the balance looks high, they feel confident. If it looks low, they immediately become worried. Unfortunately, the bank balance tells only part of the story. A large balance may include customer deposits for work that has not yet been completed, money reserved for payroll next week, upcoming rent, supplier invoices, loan payments, or taxes that are still unpaid. On the other hand, a temporarily low balance may not be a problem if several large customer payments are scheduled to arrive within the next few days. Making business decisions based only on the current bank balance often leads to poor financial choices. Owners either overspend because they think they have extra cash or panic unnecessarily when temporary fluctuations occur. Successful business owners look beyond today's balance. They monitor future cash inflows, upcoming obligations, payment schedules, and cash flow forecasts before making financial decisions. The goal is not to keep the highest bank balance possible. The goal is to maintain enough available cash to meet future obligations while supporting steady, sustainable business growth.